Good morning, everyone. Tim Nyland here. Today is Thursday, November 19th, 2020, and I'm doing a special pre-recording of a weekly strategy call for Zacks Professional Services. What we're going to do today is look at another equity strategy piece, this time on the home builders themselves. And as of this morning, we actually got some new data in on existing home sales in October, and obviously those continuing to soar well past expectations, rising 4.3% compared with September, and the annual read was an increase of 26.6%. And so if you're confused as the future direction of home builders, you're in good company with the rest of the buy side. The media, as recently as this morning, continues to talk about how on fire the housing stocks are. But when we look at valuations themselves, the valuations definitely do not reflect this level of enthusiasm. So we're going to dive through this. And the one thing I want to explain to everyone before you just jump in and try to determine valuations and trends in home builder stocks is you've got to really take a much more macro view first and really dive into the entire cyclical space to understand what's going on from a trend perspective. And we've covered this over the past couple weeks to various extents. And what I want everybody to see here in looking at this Zacks research system price and earnings chart, and keep in mind I've got EPS lagged again by 1 year so that we can actually get a visual fit of this current run-up in valuations relative to where earnings are actually going to be 1 year forward. So that's what that's telling us. And you can see that when I take this universe of 200 cyclical stocks and look at them in aggregate in the form of a composite in the Zacks research system, I can see some really clear trends. I can see exacerbated economic cycles here in earnings. I can see us working through this COVID trough. But I can also see we've had a tremendous run-up in cyclical stock valuations that actually started at the bottom of the COVID crash. And the expansion really took off right around June when we had that first expansionary read of the ISM that I covered 2 weeks ago in that strategy call. And so valuations at this point appear to be fully valued. As a matter of fact, if you look at PEF 12Ms on these groups of cyclical stocks, it's almost like the buy side is actually anticipating these sell side estimate revisions are actually going to improve. So we have some tremendously stretched valuations at this point. I would say that it's fully valued, and that's probably at a minimum. So to the extent we can get some continued sell side estimate revisions on the upward side, it would definitely justify this move. But overall, we're definitely looking at full valuation at a minimum. So again, we need to know our cyclical valuations cold. I recommend starting to look from the macro perspective at an aggregate proxy like the Zacks cyclical portfolio, and then diving into a few of the bellwether cyclical names just so that you can see what's going on in terms of the actual business cycle for companies like Caterpillar, like John Deere, that are outside of perhaps the home building space, so that we can draw some conclusions on how these stocks tend to trade. And what I want to bring to everyone's attention, again, we're looking at earnings lagged by 1 year, and the importance of that is that cyclical stocks tend to trade at a minimum of 1 year forward earnings, sometimes even go out 2 to 3 years forward. And that's kind of what we're seeing here with Caterpillar. And so lagging this earnings series by 1 year puts the chart in proper perspective. And what you can see is you can see when Caterpillar has these bouts of PE multiple expansion. And then back here in 04, if the buy side gets a sense that these estimates might roll over, you'll see that for months on end, this valuation will contract. You'll see this PE ratio, the distance between the price line in blue and the earnings line in orange, will actually contract. And you actually get contraction all the way to that PE multiple of 10, where those two lines end up touching. That's a forward PE multiple of 10, because we're looking at a log scale here and we're actually multiplying the earnings buy 10 to scale them properly against price. So you can see here, confidence gets restored. We get a multiple expansion, and then all of a sudden the buy side feels it's going to roll over again, and we crash back down to the earnings line. Same thing happens here. Financial crisis hits. We crash almost to a PE multiple forward 10. We get a nice recovery, and you can see confidence building. We get scared again. Confidence builds. We get scared again. It rolls over. Same thing here. We've got a really, really tremendous sense of optimism now in this recovery. And what happens when the buy side gets a sense that these estimates may not come to fruition? Well, you're going to see a healthy correction. And so we just need to know that the underlying cyclical valuations of some of these bellwether names, it definitely validates what we're seeing at the macro level with the cyclical portfolio. And then the next thing I encourage everyone to do is know your suppliers, right? I maintain an entire list of building product suppliers in my own advisor tools so that I can gauge a pulse of that sector of the economy. And if you look at a company like Boise Cascade, which actually caught my eye many, many months ago as I was shopping in Home Depot, I was standing in the pro checkout line, and there were probably 3 lumber carts in front of me, all loaded with Boise Cascade plywood and lumber products. And I said to myself, boy, I better take a look at the stock. And I did that probably back here sometime. And well, we all know what's happened to lumber prices and the stock price of Boise Cascade since. But notice in this Zacks Research System price and earnings chart for Boise Cascade that I'm showing you now, I do not have the earnings lagged by 1 year. And the reason for that is I'm not looking at valuations here for Boise Cascade. What I'm looking at is what the forecast demand is for lumber. So if Boise Cascade were still going to be on fire from a growth perspective, perhaps this trend would be continuing. And what I'm actually seeing here is estimates rolling over and to the tune of a 40% decline in 2021. Okay, and then we get growth continuing out. So something to be aware of. We've got to ask ourselves some challenging questions, right? How much the demand for lumber and plywood has been pulled forward due to COVID and the stay-at-home economy. And that's definitely a valid concern, right? The idea is if everybody's vaccinated by the summertime next summer, perhaps people are going to be postponing the idea of purchasing a new home or even doing a new kitchen remodel or putting an addition on the house and instead taking a vacation. And perhaps that's some of what we're seeing here. Okay. The other thing I recommend that everybody does is actually take a look at others outside the vertical, but those that are still correlated with housing. And what I mean by that is a company like Floor Decor, which has actually come up several times in my discussions with advisors and RIA firms over the past several weeks. This is a really, really popular retail and contractor flooring outlet. And the idea here, when you look at actual implied valuations, in other words, what the buy side is actually paying in terms of a growth rate for a company like Floor Decor, is in stark contrast to the actual sell side estimates for growth. And so the buy side is super, super smart, right? Because they look for scenarios where, you know, revenues might be being pulled forward by even a year, 2, or even more. And you can see that the bet here is these consensus estimates for FY1, 2, and 3, all over 20%. When we use the Zacks valuation model and we actually quantify all of the forecast information in terms of an actual market implied growth rate, we're only getting a 14.32% bid to valuation on the buy side. And that's after this tremendous run up in price. Okay. So I put a little caption here in the chart, right? COVID pulled demand forward, question mark. The buy side is definitely not paying for this growth. So the bet is right now with a company like Floor Decor that these growth rates that are even forecast for delivery here over the next 3 years are going to end up normalizing out to somewhere around 14.5%, which is what we see historically with Floor Decor. Okay. So this is super, super important. And when I did the analysis here as well, I looked for top line growth kind of mirroring these growth rates, and it was intact. So this is real. The buy side is very concerned that this demand has basically been pulled forward related to COVID. So let's take a look at what's going on with the home builders. Lennar will be the first one that we look at. And I want you to take a look at how Lennar trades, right? Just look at how this price line literally walks the earnings line. And since we're looking and talking about valuation, again, I've got this Zacks Research System price and earnings chart lagged by 1 year. And you can see that back here in 16 and 17, we had solid forward multiple expansion all the way from the financial crisis up until about the end of 2016. And then we started getting really, really apprehensive about this particular company. And what I mean by that is that we've literally got a scenario now where the buy side is only willing to pay for the earnings that Lennar is willing to deliver. And that's why you see this price line literally hugging this trailing 4 quarters earnings line. And when you see these forward multiples of 10x or less on these types of companies, it's literally a vote of no confidence on management's ability to deliver on forecast growth. And if I were to put this into my valuation model and use interpolated data, even all the way out to FY2 and 3 on these growth forecasts, my market implied growth rate would rein in right around GDP growth historically. And that's the message that the buy side is sending to Lennar's management team, saying, look, we don't know what's going to happen with these estimates. The buy side has absolutely no confidence that these estimates are going to be delivered. There's actually fear potentially that this would roll over, and there's a multitude of reasons for that we'll discuss here in a minute. But the idea is, the message is, you deliver the earnings and we will give you the price. So if you can deliver earnings up here at $8.59, the price will rise to meet that, but not a penny more. So really no confidence here in the buy side for this particular home builder. Let me see if I missed one here. Yeah, I did. Sorry about that. Next company we're going to look at is DR Horton, and it's got very, very similar price action to Lennar. It's almost a mirror image, right? Same exact scenario here coming out of the financial crisis, nice forward multiple expansion. And you can see that because we've got space again between the blue line and the orange line. And then at the end of 16, we collide and we start getting really, really scared. We get a multiple run up here and then we crash back down. Now you can see we're inching up here to the earnings line again, but we're still looking at that PE of roughly 10x on forward earnings, and it's still a vote of no confidence on even DR Horton's ability to deliver on these numbers. Okay, so again, if I were to run this through the valuation model, I'd be looking at an implied growth forecast of roughly GDP growth. And the reason for that is whenever the buy side is unsure of a company's ability to deliver on earnings, the buy side will always give it basically a minimum bid to valuation of the growth of the overall economy, which is GDP growth, which is what we see. It's one of the factors we actually use to tune the valuation model. Okay, so now onto the Pulte Group. And this one is a little bit different. We're actually trading at a PE of 8x, which is even less than 10, obviously. Still a vote of no confidence, although it is possible that Pulte could actually see another increase up to the earnings line. It wouldn't surprise me. This one's really going to depend upon their book of assets and how much land they've got on the books and other factors. I haven't actually dug into that yet. We're just talking generally speaking here, what we're seeing. So that is a possibility, but again, overall, a strong vote of no confidence on being able to deliver on this earnings growth, which is absolutely spectacular. I mean, if Pulte can actually hit these numbers, 28, 19, 18% growth, I mean, it would just be spectacular. But again, the buy side is not thinking these numbers are going to come in. Otherwise, we would actually get this price to that earnings line. Perhaps it's undervalued. We don't know. That's the bet. Okay, that's what we're betting on. Okay, so we'll just wrap this up very briefly. These PE multiples for cyclical names that we're looking at the 8x to 10x on forward earnings is again a vote of no confidence on management's ability to deliver on this forecast growth. So the idea specifically for the home builders is it fear of a rise on the long end of the yield curve? In other words, if the Fed's not going to intervene on the long end of the curve to keep rates low, we get rates skyrocket with the threat of inflation, which I'm not sure I'm in that camp, but anything is possible. Given the amount of stimulus we have and could potentially have under a Biden administration. Is that part of the fear? Perhaps it is, right? The other part of this is obviously the fear of the COVID vaccine alleviating that housing demand. I mean, it's very, very possible we get a vaccine out next year and people decide to put vacations and actually, you know, perhaps putting off that relocation and actually staying put instead of moving from the cities out to the suburbs. So we could actually see this trend that we've started over the last, 11 months kind of fade out pretty quickly. Regardless, even if it's not either of those two, the reason I wanted to show you these long-term trend charts is it's not uncommon for home builders to be valued in this manner regardless, right? It's a signal that, again, we as investors, we really need to take note of this. So keep this in mind, right? Buy side will only pay for the earnings that management is able to deliver. The price will continue to walk along the actual delivery of these earnings unless the buy side ends up getting some vote of confidence from something that's going to continue to drive that demand for housing forward. And that would be more of a generational type shift thing where we actually have a significantly lower number of homes than we actually need, and we may need to play a catch up. This is exactly what happened after the Great Recession. So we would need to be looking for some sort of secular shift in demand for that to play out, and I just don't see that happening right now. Again, this is typical for highly cyclical industries such as home builders, and again, the fear is that EPS forecasts and actuals can actually roll over at any moment. So again, the media as recently as this morning continues to talk about how on fire housing stocks are. I don't dispute that. They have had a sizable increase, but when we talk about valuations in terms of price relative to earnings, they simply do not reflect this level of enthusiasm that the media is portraying. So just be advised that this is the behavior of the home builders. It is normal, and but it's something that we need to pay attention to. Feel free to hit me up on LinkedIn. Feel free to hit me up on Twitter. And if anyone wants a copy of this slide deck, please just send us an email at advisortools@zacks.com. If you'd like to speak with me more about home builders, self-service providers, or anything else, reach out to me, send us an email, advisortools@zacks.com, zrs@zacks.com. We'll be happy to assist. I want to wish everyone a happy and safe Thanksgiving, and we'll catch up with you the following week. Thank you.